Jeff, how you doing this morning?
I'm well, Tim. I'm energized, feeling good, excited to talk about due diligence.
Favorite topic here.
Yes.
All right. Well, thank you everyone for joining to the due diligence playbook, how to protect your valuation. This is part of the Growthink M&A series. It's a series of monthly educational webinars for those who are considering an exit in the next handful of years. Even if you haven't been considering an exit, it's still a very good time to jump into webinars such as this. And we would highly recommend, if you have a moment, to check out our YouTube channel. So just find us at Growthink on YouTube, and you'll find a whole series of videos on the same topic. Today's topic, due diligence playbook. We understand that most business owners don't lose value when they sell, they lose it during due diligence. And even though due diligence is a necessary formality, it's also the buyer's secret weapon. And today we want to make this your secret weapon, the seller's secret weapon. And this isn't because the businesses are bad per se. It's generally because the sellers aren't looking at their business through the buyer's lens. So we want to show you how the buyers view diligence and how you can use this to your benefit. So this is about making diligence your secret weapon today and protecting your valuation, plain and simple. And to lead us through this charge, you're in very capable hands with Jeff Jones, managing director at Growthink Capital. Jeff lives and breathes all things due diligence.
Yes.
So you're in for a treat, and we'll have some Q&A towards the end. But if you do have questions, feel free to just drop them in the chat, and we'll be monitoring those as we run along. This should run for about 30 minutes. So let's say the last 5 to 10 minutes or so, we'll have some live Q&A. Jeff, let's get
Yeah.
into it.
Thanks, Tim. I guess that's why my wife thinks I'm boring. Everything I do is due diligence, right? Live and breathe. Man, that would be a
Woo.
boring existence. But part of what I do is that. So yeah, let's get into it, everybody. Good to be with you. Excited to kick off our first of the year webinar here. We had several last year, took a little break, and we're back now. We're going to continue to get into the nitty gritty of the M&A cycle and process as it relates to sellers and owner operators. And so this one's a big one. I don't say it's overlooked, but I don't think unless you've been through it, you really understand what it entails, what happens, and to your point, Tim, the leverage you may have as a seller to be able to take advantage of it. So I think the first thing you need to understand is, and as we say in every kind of webinar we do and in our just general guidance to our audience and our clients, is it comes down to preparation, and you'll hear a lot of this today in these slides that I talk through. But due diligence isn't just about verifying things for the buyer and finding problems. It's also about pricing risk associated with the transferability of the business itself. And so there are different parts in the M&A process where sellers have leverage, and there is, deal making that goes on. And yes, that definitely affects valuation, obviously historical performance of the business and the growth opportunities and all these things. But during the due diligence cycle is where you see most of those valuation losses incurred on the sell side. And so some interesting things to consider. 70% of those renegotiations or retrades by buyers are driven by their findings during the due diligence process, which I don't think a lot of people understand, depending on what they uncover, whether they're surprised by it or not. They have the time and ability to reassess. And when they do that, they will come back and retrade. But, they're usually going to try to reprice or retrade a deal before they just walk away. And there usually are a few cycles there. So it does happen often. It doesn't always happen, but consider that during this due diligence cycle, when you're in this exclusivity period of, call it 60, 90, 120 days, that's when this all goes down. And so to my point about preparation, due diligence readiness, and DD, by the way, we're abbreviating for due diligence today. That is your highest ROI initiative as a seller, right? You can not necessarily control it, but you can prepare for it in a way where that uncertainty doesn't apply, meaning less risk for the buyer. Everything runs smooth and clean, and the deal as proposed closes as proposed versus going through a bunch of hurdles and retrades and usually erodes the outcome. So that's something to consider, is you do have some control over this with preparation, which we'll talk about today. And a lot of people don't understand, this can start months before any kind of formal LOI is actually delivered or issued by a buyer. It's quite amazing the last few years how front-loaded due diligence has become, even after the first couple introductions or calls with the buyer, and what they expect to uncover and find out before they put a ton of time into that LOI process. And so, it could be months in advance. You have an initial conversation with a prospective buyer, they'll start asking for information right away. And you have to be prepared for that. And so keep that in mind. It's not just post LOI. There are cycles ahead of it in advance that allows you, by the way, to build your case, defend your strategy, and also your valuation. So a few pointers there we can discuss as well. So buyers are trying to eliminate uncertainty, right, and risk in this process. Again, it's not just verification of what you're telling them. That's a big part of it, but it's underwriting risk and sustainability and transferability, where I'm going to acquire your business and what comes along with that, and how easy will that be to integrate going forward, and can I capture that growth upside that we've discussed, based on what you're telling me. And so that's really it. And so in doing so, the due diligence process has become very intense, very rigorous, very thorough, and the discipline around which buyers operate is quite impressive. And what I mean by that is, when you look at a data room, for example, or a due diligence checklist, and not to discourage people, but there could be 100 items on that checklist. There could be 1,000 items on that checklist. They will get what they want to get before they close the deal. And I think that puts sellers at a disadvantage, not just psychologically, but actually from a deal-making perspective, right? And so the goal isn't to just survive that, it's to prepare in advance and actually be able to control the narrative leading up to it, which allows you for that smooth due diligence process all the way to close. So again, I also want to point out, this isn't just about valuation and deal composure, right? And getting through it. It's about closability, right? The cleaner you are going through this process, the better chances of actually getting a deal closed. And that's huge. That's just as important as any valuation figure you're expecting. And so that's something to consider.
Yeah, I think it's important to maybe highlight just briefly the close rate of deals on the market, just at a macro level. It's not 100%.
Post LOI, Tim,
Yeah.
it's roughly 60%.
Right.
So even at that stage, when there are levels of due diligence happening before a formal LOI is delivered or issued by a buyer, right? And that continues to erode. But yeah, 60%, 40% of that essentially is a failure rate. And that's kind of a market metric. It depends on the deal and the industry sometimes, and maybe even the banking firm. But yeah, odds are kind of against you through the process. And so this is why, again, could be an arrow in the quiver, where you're presenting a clean scenario to a buyer, and that due diligence process is as expected. Huge advantage for you.
Yeah, and one last thing I want to point out is, I think we had talked about this in maybe one of our other webinars, but about this spectrum of certainty. So if you're completely uncertain on one end and absolutely certain on the other end, then value kind of tracks over that spectrum. So ultimately,
100%.
I think we're just trying to move people towards, like you said, underwriting risk.
Yeah, right. And if you're going down too far in that spectrum, there's the way they underwrite risk is through discounts, right? And retrades, and they're repricing, as I said earlier, or they just don't do the deal at all, right? So there's the nuclear option and everything in between. But it doesn't, from the LOI side, from the seller, it's not as if it's going to get better for you going through due diligence. That's probably the high watermark of the deal making cycle. And so that's something you should consider, of course.
That's a good point.
Yeah. So let's get into a little bit here. Some things here are technical, of course, but we've talked about a lot of this stuff in the past. I'm trying to bring it all together for you in terms of, buyer and seller perspective. So what the buyers are actually looking for. So what they tell you is okay, we want to verify revenue accuracy, categorization, segments, and all of these things. What they're really looking for is durability, right? How does this hold up? Is there a concentration problem with your customer base? What type of revenues do you have, recurring versus project based, right? Something we've talked about a lot in the past. Recurring revenues are going to provide more predictability and certainty and valued higher, right? Pricing power you might have, churn in your customer base, the quality of your agreements with your customers, especially if you're B2B. And so, what you hear and what they're actually looking for might be two different things, right, to consider. The second thing when they look at EBITDA normalization, right? So we talk about this a lot, quality of earnings, EBITDA add backs. I think that was our last webinar, Tim.
Right.
That actually means transferability risk, right? So EBITDA normalization could come down to owner dependency, your depth of management team, the stickiness around your customer base, systems, and institutional knowledge around transferability, right? So when they say normalization, what they're saying is this how it's going to perform going forward? And is that what we can expect, right? From there, the quality of earnings, we talked about this as well, pre-market Q of E, post-market or a buyer Q of E, getting into understanding EBITDA adjustments, but really they're looking as well at cost pressure and margin sustainability, right? So is there deferred maintenance cost to consider? Is there underinvestment in the business where we have to deploy a lot of capital to meet these growth trajectories or growth projections we're looking at? What kind of CapEx is involved going forward, right? Look at the reported add backs and the one-time versus ongoing expenses. A lot of things come down to working capital normalization and such. So a lot of things that go into this kind of cost pressure and quality of earnings conversation beyond just a Q of E exercise to consider as well. And then finally, there's this thing we call downside protection, where a buyer says, we're going to look at legal, we're going to look at tax, this compliance piece. Well, the reality is, what are our risks on the downside here? Where could earnings and revenue and EBITDA fall in the next 1 to 2 years? What might break our investment case or thesis with this business? What justifies structure and holdbacks and earnouts, things of that nature. So again, this is not just an audit, but it's a risk pricing exercise when they go into the weeds here in terms of what they're telling you and then what they're really looking at, and kind of I guess some hacks here to consider. Okay, what does this mean and what I should be doing to prepare for it?
What about from the financial buyer, PE buyer versus strategic buyer lens? What they tell you and what they're really underwriting. What are the subtle nuances there?
I think for the most part, what I'm looking at on this slide, Tim, is coming from the financial buyer perspective more than anything. Where that's going to differ, where you have a strategic buyer, is going to be more related to the synergy between the two companies and the general integration. When you think about teams and brand and cost drivers, things of that nature, right?
Culture.
Culture, exactly. So when you kind of bake and tuck in that acquisition from a strategic perspective, that's kind of where that nuance is. But from a due diligence perspective, your strategic buyer, your private equity buyer, for example, they are all going to still have outside firms, third-party validators to go through all of this and still do the same analysis. Yes, those due diligence checklists will vary depending on the buyer profile, to your point, but the reality is all of this is going to come into play at some point. And so I think this is kind of a general piece for just about any buyer profile out there. If a buyer presents an offer or a deal framework to a seller, puts in an LOI, you have a formal value evaluation, price for the company and structure and how that deal is going to go down. Post LOI in due diligence, they might uncover something they don't like, for example, and they might come back and say, we got to price this risk in. Instead of $50 million enterprise value, we're going to take you down to 40, and we're going to bake in some additional structure such as earnouts or holdbacks. That would be a retrade, right? It's just a renegotiation of what they've already offered that isn't necessarily formalized yet, right? and non-binding. And so that can go back and forth depending on what they find. Okay. And that is a big reason why deals fall through. It's because if you're spending time and money in the LOI and due diligence process and going through that with your buyer, and they come back and give you a haircut or retrade based on what they're finding, or maybe that was just their strategy in the first place, is we'll start high, we'll get them in, we'll start the process, and it's a lot less likely they walk away if we come down 20% on the offer, right? Does happen, happens all the time. And again, I'm not, putting the onus all on the seller, but again, there are mistakes to avoid where we think a lot of valuation damage is somewhat self-inflicted in this process. And so to think about like how you as a seller would get punished, we've talked about this in many webinars as well. It comes down to kind of the financial inconsistency, but when we are showing or a seller is representing EBITDA add backs that are unsupported or maybe aggressive, could be personal expenses without documentation, growth investments disguised as add backs, for example, one-time costs that actually reoccur, right? So there's always kind of a little fight around the EBITDA adjustments getting back to the Q of E. If that happens, and you're overly aggressive and the buyer doesn't accept this stuff, you're going to lose credibility. You're going to lose trust. And right there, that's where you hit the retrade, or that's where you see a haircut across the board, right? You're going to get punished for that. The second thing is always the case, right? It's when we encounter a business, a lower middle market company, owner, operator, family owned, for example, sometimes they're buttoned up, sometimes they're not. And not having third-party reviewed financials, or they're inconsistent or poorly prepared, huge problem every time, right? So pre-market, if your investment banker and your advisor ask you, hey, let's look at a P&L over the last 12 months. If it takes 4 weeks to get there, and that's not really clean, then we got a problem, right? So there are a lot of things that can go into this, revenue recognition issues, tax inconsistencies, trying to fully understand the financials. From a recent experience, we had a client moving from cash to accrual system. Massive confusion in the financials from 6 months ago to today. That's a problem, right? So having these things figured out ahead of time definitely reduces the risk here of getting dinged through the deal process. So financials are a problem. The Q of E expands, right? Timeline slips. You have pricing pressure now. All of these things potentially start breaking down. The next, not disclosing potential surprises and landmines. So this could be, employee risk. You have key people that are a little scared about selling the company. They might want to go elsewhere, and that's not being disclosed early to the buyer. You have a concentration problem that's not disclosed. You might have some litigation or tax issues that you're not disclosing, regulatory issues, depending on what industry you're in. So again, that's only going to extend timelines, create some distrust, and again, justify retrades. The next one is interesting, right? So a big part of our job as investment bankers is to prepare you for all of this, but we can red flag this very early, Tim, where we're asking for information and it takes a long time to get it. Buyers are going to see those red flags as well. And so ahead of time, you want to prepare your data room. You want to prepare your framework. If the data room is weak and buyers are requesting information, it takes weeks to get back to them. Again, you're going to be perceived as an organization that is unorganized, right? And there might be some chaos, or the information might be inconsistent or missing. Guess what? Risk premium increases. So if I'm a buyer, I'm going to adjust for that.
Yeah.
Okay. The fifth we talk about all the time, owner dependency, not being addressed, for example, early on. That's a problem, right? You don't have a second in command or professional management team, or the owner is tied to everything around operations, customer relationships, culture, day-to-day ops, whatever that might be. That's going to impact post-transition or post-transaction and transition close. And the buyer is simply going to say, okay, if we need this person or these people, fine. But now we got to create some structure. We got to create some incentives for these people, such as earnouts or equity rollovers, or even discounting valuation, right? So a lot of stuff to think about there. And then finally, when you go to market, you got to prepare to talk about the future. I think a lot of people make this mistake in due diligence where they just think it's historically based, right? Granted, buyers are asking for information from the past. We get that. But part of that story has to be about what's going to happen in the next 2 to 3 years. And so a big part of what we do with our clients as we prepare them to go to market is think about, from your perspective, Mr. Owner, what is the growth trajectory of the business? What could happen if you have a good partner or if you have some capital? Let's build that story, right? So if there's a lack of growth story that's not getting people excited, then what they're going to pay for is what you've done historically and not give you any credit for what potentially could go forward in terms of growth potential and upside for the business.
And that's one of those things where, the CEO, the owner,
Yeah.
they've been selling their entire life of their business.
Yep.
They are very good at telling their story as to why they have a unique value proposition for their products or services in the market. We're just asking you to put that hat on for your business. It's still sales at the end of the day.
It is. And I would think that is the institutional knowledge that needs to be shared and carried over to him. That's a great example. Just part of the stuff around owner dependency, and again, kind of professionalizing your company. So I go back to the word at the beginning of the call, transferability, right? That's how these things are priced. And that's how due diligence gets done, is verifying that and getting very comfortable with the asset transferred to a new buyer going forward. And that's a big part of it for sure. All right. So, a lot of points we've touched on here, but again, trying to add value in this call for you as an owner operator, some key nuggets you might be able to pull away from this discussion today, and things you can get started on well in advance to thinking about going to market and selling your company, right? So again, making due diligence a confirmation and not necessarily an investigation, right? And so there's things you can do to prepare so you go to market clean and ironclad, if you will. And those offers and those premium prices that are getting pitched by buyers actually stick. Okay. So, we'll start with pre-market readiness. Again, think about revenue quality, think about revenue streams, how to define that. The highest level of the pyramid, of course, is going to be recurring revenue. So how you defend that, how do you build the recurring revenue streams into the model? Think about your EBITDA add backs and adjustments early. Have an itemized schedule, because as you go into financial and due diligence and QV, this is going to be scrutinized. It's okay if you're an owner operator, if you're passing through owner discretionary expenses, good for you. That's what you should be doing, but you have to track it. And if you want to get credit for it, and it has to be one-time cost versus recurring cost, right? We are recommending this more and more. Go out and consider a pre-market QV. Yes, it costs a little money. It takes a little time, but man, if you go to market with a sell-side QV as a seller that you could present to a buyer pre-LOI, that's going to help you tremendously. And we fully back that now. And there's a lot of reasons for that over time with valuation compression and deal structure that buyers are introducing now. It's much more exotic, deal making world. And that QV helps straighten those things out, clean those things up. And then kind of a normalized working capital worksheet to think about, where buyers are going to be looking at adjusting before close what your business needs to make its obligations over the next 3 to 6 months, right? Current assets over current liabilities. Have your CPA, your CFO, your accountant, your financial person build this out, pre-process or pre-market. And again, that's what investment bankers help with as well, to get you feeling good and comfortable about that going forward. Because you'd be surprised where $100,000, $300,000, $500,000 working capital adjustment at the end of that deal could blow the whole thing up. Okay. Yeah. So things to consider. The second box, we've kind of touched on this already, right? You de-risk your story before buyers are going to test it. Professionalize the management team. Customer concentration issues. These are very easy to identify. Customer concentration being any one customer that represents over 20% of total revenue, right? And the trend line of that over the last few years. Customer contracts should be formalized, right? Identify those growth drivers for the market from your perspective and your point of view, as I said earlier. And last thing, very important, when you build your financial model, okay, whether it's your banker, your CFO, or you do it internally, don't go to market with unrealistic expectations. If you're doing 30 million in top line and 20% EBITDA, fantastic. And if you haven't shown great growth over the last 3 to 5 years, maybe good growth, 10, 20%, keep it that way. That's okay. if you're showing 50% growth in year one and in 2 and 3 to try to get the market excited, guess what's going to happen? The buyer is going to hold you accountable to that. And now they're going to base off of what you've done historically does not necessarily represent what the future growth is. Sure, that's exciting, but they're going to tie your deal to that growth in terms of earnouts and equity rolls, right? So they're gonna hold you to that and make you accountable to it. So consider that when you go to market. We're not raising Series A tech capital here where you got to have $1 billion market opportunity in year 3. This is a nice steady growth trajectory of a strong business fundamentally, and that's what you have to show going forward. So don't get ahead of your skis. And then finally, again, controlling the process strategically. So this is something us at Growthink Capital as advisors really help with. Getting informed, getting smart before you go to market as the owner operator here. Anticipate what valuation might look like, right? There are ways to understand that, not just anecdotally, but good data out there in the market where, hey, listen, you're probably worth this range, right? We can talk about EBITDA multiples or something else. And we should probably anticipate some structure, right? A lot of deals these days it's not just cash up front, but there's equity rollover potential, there's earnouts, there's holdbacks to consider, maybe seller's notes. It's unlikely every piece of structure is going to be thrown at you, but there's going to be some structure 80, 90% of the time. Okay, so let's talk about what you're comfortable with and what to be prepared for. So when that does get delivered to you and offered to you, it's not going to blow up the deal. Okay.
I mean, Jeff, in your experience, how common is an all cash, one check deal?
Extremely uncommon.
Yes.
We did it, even if it is all cash, there's still going to be some kind of holdback for a year or two, Tim, maybe 10 to 20% of the overall deal, just to kind of navigate those risky waters, for example, of, hey, okay, we're gonna give you credit for this, Mr. Seller, but over the next year, we got to make sure it actually comes to fruition, or something's going to happen, or the reps and warranties, or there's any claims on the business, whatever it might be, that holdback is still there. But I don't know. 1 out of the last 5 deals, 6 deals we've seen, maybe would be an all cash component. Now consider too that in that situation, Tim, and we're getting a bit off topic from due diligence, but this is part of it, that you might get multiple offers and one might be cash at a lower valuation, but that might reduce the risk to you as a seller versus something much higher valuation with structure and evolved, right?
Yeah, that's a good point.
But due diligence will inform structure for the buyer, right? And so again, that's why we anticipate it. So again, tight data room, control that process, right? Provide people privileges on what they can and cannot see, but again, 80% of those due diligence checklists, maybe 80% are going to be the same, right? Standard stuff. So we can prepare for that in advance. And the other 30% might be customized based on your business, based on the buyer, that we can kind of scramble to get ahead of when we start having conversations. No problem. Okay. The next point, align an advisory team. This helps with due diligence, right? You want to build a team around yourself. Financial, CPA, accounting person, right? Investment banker that understands how to run a process and get a deal done, right? In terms of deal making, negotiation, and structure in the process. M&A attorneys. This is going to help dramatically in due diligence when you have someone on the legal side that can help support you throughout the process. And then think about kind of wealth management, wealth advisory roles as well as your team as you think about the due diligence process going forward. Prepare your team for this. If you have key people that are important to the due diligence process, right, to get information, then you need to involve them, right? And know that's sensitive sometimes, and whether or not they get excited about selling the company or not, those people are really important to get involved in the process early. So as those requests come in, it's fluid, it's consistent, and you're getting the expert on your team with that institutional knowledge to answer those questions, because it's only going to help you at the end of the day. Right. And so, and then the last thing I'll say here, actually a couple things. Negotiation on exclusivity and timing. Post-LOI, right? The negotiation of the LOI will involve that exclusivity time that allows the buyer to come in and do that due diligence on your business without you talking to other people in the market, right? It's non-binding from a deal perspective, meaning you don't have to close, but it is binding from an exclusivity perspective where you can't talk to others. So you can negotiate that. Naturally, buyers want longer time, sellers want a shorter timeline, right? And so that's a negotiation tactic to help you in due diligence and gain leverage. We recommend you take advantage of that if possible. And then just trying to limit post-LOI scope creep. So when you see the LOI language and your banker and you and your attorneys are looking through it, it's let's think about maybe some information or questions here that might be hard to interpret or get misinterpreted when the buyer's looking at it. That could extend a timeline 30, 60 days, right? So let's have real kind of narrow framework for what they want and why ahead of time so that scope creep doesn't exist and they don't keep adding 15, 30 days and extending your timeline to close. Okay. So some I think some good advice here going forward. And then I guess kind of a recap, how it's won or lost. I mean, you can kind of think about that from a seller buyer, right? You guys are on different teams and who's going to win, who's going to lose. It's not really how we think about it because at the end of the day, that buyer essentially is going to be your partner. And so again, where it erodes, I've kind of touched on this already. EBITDA disputes, revenue classifications, working capital adjustments, deal structure that wasn't introduced before. This is all a way for buyers to de-risk or price in risk as they start uncovering things within the business and going through that due diligence process. So again, and this could be some minor adjustments. You'd be shocked at how deals blow up over a very small amount of money or time or the answer is easy, for example, based on the question. And then how sellers protect value. Again, just a recap, preparation, always protects both price and structure, right? Helps protect what you've built to get what you expect, as long as it's within reason. Get those issues disclosed early, get your management team participating in it, at least the key people, and incentivize them maybe to do so, right? And as I said earlier, leverage multiple buyers. You want to run a process. You want several buyers to come in. And part of that analysis isn't just who's paying the most, but who's going to be the best partner, who's requesting the most in a due diligence process, how rigorous is it on the front end? Like I said earlier, you're going to get some good indication of what they want early. Okay, well, maybe you want to work with buyers that are a bit more reasonable and realistic, or maybe their checklist isn't as broad or robust as others. That could be a nice way to think about it. So get prepared, think in advance. This takes a lot of time to put together, but when you are ready, it's going to make the deal happen, which much higher likelihood, and also not erode the value for that seller going into the process.
Jeff, you had a bullet in there earlier about this being one of the highest ROI activities going through the diligence process that a business owner could do. Is there a time when a business owner could consider doing this? Let's say someone doesn't want to sell for 10 years.
Yeah.
Would you say that's too early for them? What's the benefit of doing this earlier than later?
Well, I think there are a lot of things to consider when you're 10 years out that I think you need to think about some of these points as a discipline for your operation, right? Clean financials, recurring revenue streams, customer concentration, owner dependency that are part of that due diligence process that take time to clean out and prepare for, Tim. So those things should be kind of a muscle building exercise for the organization, generally speaking. Getting up to a point where you are considering go to market, a lot of these other things around data room and advisory teams and Q of E, yeah, I would say 3 to 6 months in advance would be appropriate to make sure we are overcoming any foreseeable hurdles and getting things as clean as possible, especially the financials and things of that nature.
Yeah, it's the top of the year, and this is when people start kind of getting into gear. There's a lot of activity out there in the market right now.
Yeah.
Of hey, I got an email from someone that said they want to buy my business. What is the process of going through exploration with Growthink? How long does it take for you to jump on a call? What does a free consult feel and look like?
Yeah, so it's a couple steps. I think first and foremost, it's a conversation and get to know one another, but mainly understand what you want as the seller. What are you looking to do, right? How does that solve for your business, personal, family, wealth, et cetera, right? So understanding where you want to go and then working our way back to today and determining how to get there is number one. Number two, it's a deeper dive into the business, into the market and what's going on out there, right? To get informed so you understand what to expect going forward. And the third piece is to build a strategy around it, timing, go-to-market process, and then actual execution. So it's a few calls, Tim, to kind of get ramped up and get comfortable. But this is not, it cannot go fast. It can't be a rush job. And so if you're thinking about selling in 2026 at some point this year, you better start having that conversation right now.
Yeah. All right. Well, with that being said, we'll put your contact information. This will be posted on our YouTube channel. Once again, if you're new, please like, comment, subscribe, find us on YouTube, find us on LinkedIn, get notified, get involved, take a proactive step in your exit journey. We're here to have conversations. Reach out to Jeff Jones. His wealth of knowledge. We'd love to have a call with you. Thanks, Jeff.
Thanks, Tim. Thanks, everybody. Take care.